A lot of people are convinced that when they take a big stack of cash to the bank, the safest move is to keep it just below $10,000. It sounds cautious. It sounds smart. Sarcastic. And that idea has been repeated for so long, between friends, neighbors, and even within families, that it feels like an official rule. What most people, especially retirees, don't realize is that this exact habit can create the very situation they're trying to avoid. Curious. The moment you start breaking one larger cash amount into smaller deposits for the purpose of staying under that limit, you can step into an area federal law treats very seriously. The people who get caught in this situation almost never had bad intentions. They're not running some secret operation. They might have sold an old truck, accepted help from their kids, or moved their own savings from one bank to another. Completely ordinary, legitimate events. But the banking system doesn't see the story behind that money. It sees dates, amounts, and patterns. Sometimes the pattern alone is enough to trigger questions. I want to explain exactly how this works, because once you understand the actual rule behind that $10,000 number, the whole topic becomes much clearer and much easier to manage. A bit later, I'll share the story of a retired teacher who ran into this issue simply trying to get her finances organized after her husband passed away. Her experience shows how easily an honest person can get caught up in this. Hi, I'm Artur, and I spend a lot of time looking into the kinds of financial rules and banking habits that tend to surprise retirees. Not because the rules are hidden, but because what people hear through word of mouth is often very different from how the system really works. Over time, certain bits of advice spread quickly in retirement communities and among families. Someone hears something from a neighbor. That neighbor once heard it from a teller years ago, and before long it turns into a rule everybody trusts. That's exactly what's happened with the $10,000 deposit myth. People hear about it, try to work around it, and don't realize that the workaround can actually be the problem. This video is for general information only. It's not financial, tax, or legal advice. Always do your own research and talk with a qualified professional about your specific situation. In this episode, I'll break down what the $10,000 rule really says, what banks are truly required to report, and why the report itself usually isn't the issue. Then we'll look at 3 real-life situations where retirees run into trouble most often: selling something for cash, receiving money from family, moving their own savings between accounts. Along the way, I'll show you simple paperwork that can protect you if questions ever come up. Once you know what the system is actually looking for, the solution becomes surprisingly straightforward, and often the opposite of what people have been told. To start, you need to understand what that $10,000 threshold actually is. Behind the scenes, banks in the United States must follow federal rules that require them to file something called a currency transaction report whenever a customer deposits more than $10,000 in cash in a single transaction. Cash here means physical bills, not checks, not wires, not electronic transfers between accounts. If you walk in with more than $10,000 in paper currency and deposit it at once, the bank's system automatically generates that report. This happens quietly and routinely. The bank doesn't ask for your permission, and in many cases they won't even mention it. The report just becomes part of a large database that regulators use to monitor big cash movements across the financial system. Every year, millions of these reports are filed. The overwhelming majority never lead to a phone call, an investigation, or any further action at all. They're records, not accusations. The rule was created decades ago to help authorities spot large-scale financial misconduct that relies heavily on physical cash. When big cash deposits are automatically recorded, it's easier to see unusual activity at a system-wide level. Here's the key point most people never hear. That report is not a sign that anyone thinks you did something wrong. It doesn't automatically start an investigation. It's just a record that, on this date, this amount of cash went into this account. The real confusion starts after people hear about the rule. At some point, someone said, well, if banks only report amounts over $10,000, the smart thing to do is keep every deposit under $10,000. That idea spread fast. You've probably heard some version of, if you have $11,000 in cash, just put in $9,000 now and the rest later. Split it between 2 accounts. Have your spouse deposit part at another branch. On the surface, it sounds clever, but the law anticipated that exact behavior. Once someone starts deliberately dividing one larger amount of cash into smaller deposits to avoid crossing the $10,000 line, they enter a different category entirely. That behavior has a specific name: structuring. Structuring, arranging cash transactions on purpose to get around reporting rules, can be treated as a serious offense by itself, and the people who end up in trouble for it are often people who thought they were being careful. Someone works and saves honestly for 40 years. Then they hear well-intentioned advice about staying under $10,000, and suddenly the pattern of their deposits looks, to a computer, like they're trying to avoid the reporting system. Why do regulators care so much about structuring? Because for a long time it was a common method for moving large amounts of cash through banks without generating those automatic reports. Instead of putting $50,000 in the bank once, people would make a series of smaller deposits across days, branches, or accounts. Modern bank monitoring software is very good at spotting those patterns. It doesn't know if you're a criminal or a retired teacher. It just sees repeated cash deposits landing just below the reporting threshold, and it flags that pattern for further review. This is particularly frustrating for retirees because the people caught by these patterns often thought they were being responsible. They were trying to avoid hassle or extra attention. In reality, the very step they took to stay invisible can be what brings attention in the first place. That's why understanding this rule matters. Not because a large, legitimate cash deposit is dangerous, it usually isn't, but because misunderstandings about the rule can lead honest people to create patterns that raise unnecessary questions. Now let's look at where this shows up most often in real life. There are 3 situations that come up again and again for retirees. The first is selling something for cash. This happens all the time. Maybe you sell a truck you no longer need, a boat you never use, an RV that's been sitting for years, or a classic car you've owned for decades. Private buyers often pay in cash to keep things simple. Imagine a buyer comes, inspects the vehicle, you agree on a price, and they hand you $11,000 in cash. The title gets signed over, they drive away, and everything is completely legal and straightforward. You then take that $11,000 to the bank and deposit it. Because the amount is over $10,000, the bank's system files a currency transaction report automatically. That's usually the end of the story. The teller might not even bring it up. Later, you mention the sale to a friend or neighbor. Over coffee, someone says, you shouldn't put it all in at once. If you keep it under $10,000, the bank doesn't have to report it. Sometimes they mention $9,900, sometimes $9,500, but the message is always the same: stay under the number. So next time you receive cash, maybe from selling another item, you decide to follow that advice. Instead of depositing the full $11,000 in one trip, you put in $8,000 now and $3,000 next week. To you, it feels like you're being careful and organized. From the monitoring system's point of view, that pattern can look like an attempt to avoid the reporting rule. The deposits themselves are clean. It's the pattern that can cause concern. In most cases, the safer and simpler approach is the opposite of what people are told. If you legitimately get $11,000 from selling a vehicle, it's usually better just to deposit the entire $11,000 in one go and let the automatic report happen. What protects you is documentation, a bill of sale showing who bought the vehicle and the final price, the signed title or transfer paperwork showing the change in ownership, the bank receipt or statement showing the deposit. Together, those documents tell a straightforward story about where the money came from. If anyone ever asks later, which is rare, you already have everything you need to explain it. The second situation where retirees get tripped up is within their own families. It's very common for adult children to help parents financially. Medical bills come up. A roof needs to be replaced. A child sells a business or has a strong year and wants to share that success. A son might say, "I want to give you $15,000 to help with the house." A daughter might send money to cover medical costs insurance didn't fully pay. These are ordinary legal situations, and in many cases, the person receiving the gift doesn't owe income tax on that money. A genuine gift is usually not considered taxable income for the recipient. There can be separate rules for the person giving the gift, which is why speaking with a tax professional is wise for larger amounts. The confusion starts when everyone tries to make it easier. A child might suggest, "I'll send you smaller amounts so the bank doesn't bother you." A spouse might say, "We'll put half in your account and half in mine so it doesn't look too big." Those suggestions come from a good place. People are trying to avoid hassle. But the strategy of breaking a larger cash gift into multiple smaller pieces, just to stay under a line, can again create a pattern that looks like structuring. A clearer way to handle a legitimate family gift is usually to move the full amount in one documented transaction. If the gift is sent by check or wire transfer, the bank can already see where it came from and where it went. If it's in cash, depositing the entire amount at once and keeping a short note can be enough. That note doesn't have to be formal or notarized. Something as simple as, "I gave amount to name as a personal gift on date, signed, giver's name." Combined with the bank deposit record, that one page can make any future questions much easier to answer. The third situation, and the one that surprises most people, is when you're just moving your own savings between your own accounts. That's where the retired teacher's story comes in. She had spent over 40 years teaching. At 69, recently widowed, she was trying to organize her finances after her husband died. Over the years, like many couples, they had opened accounts at several banks, an older checking account from when they bought their first house, another account opened later, a certificate of deposit that had been renewed multiple times. Nothing was complicated from a financial standpoint, but emotionally the process was exhausting. When you've just lost your spouse, even simple tasks feel heavy. Her plan was straightforward. Bring everything into one bank so it would be easier to manage. That kind of consolidation is often recommended. It reduces paperwork and confusion. But the way she moved the money caused a problem. Instead of transferring the balances in one or two clear transactions, she moved the funds gradually. $9,000 one week, $8,000 another time, then another transfer just under $10,000 a few days later. She wasn't thinking about the $10,000 rule. She simply felt that smaller transfers might be less overwhelming while she was dealing with grief and other responsibilities. About 6 weeks later, she received a letter asking her to explain that pattern of deposits. She hadn't done anything wrong. These were her own savings. But the monitoring software didn't know her background or situation. It only saw several deposits in a short time frame, repeatedly just below the $10,000 threshold, a pattern that can resemble structuring. In cases like this, once the person provides a clear explanation and supporting records, the matter rarely goes further. But the stress of receiving that letter, especially during a difficult time, is real. The key lesson here is that a lot of modern banking oversight is automated and pattern-based. Software isn't looking at your personal story. It's looking for behaviors that historically matched financial crime. Repeated cash-like deposits kept right under the reporting level are one of those behaviors. Moving your own money between accounts you own is legal and very common. People do it when they change banks or when a CD matures and they want to move the funds. The transfers themselves are not the issue. It's the pattern of smaller moves that can raise questions. So, when you need to move a significant amount between institutions, it's often best to do it in one clear transaction if possible. A wire transfer or a cashier's check handles this cleanly and leaves a solid paper trail from one bank to the other. A banker may ask, "What is the source of these funds?" That's normal. A simple answer such as, "These are my personal savings being transferred from my account at another bank," is usually sufficient. The documentation you keep in these situations doesn't have to be complicated. A statement from the original account showing the balance and withdrawal, the wire transfer confirmation or cashier's check receipt. If it was a maturing CD, the maturity notice showing the payout. Together, those items create a clear timeline of the money's movement. This leads to a bigger point. What truly protects you is not trying to dodge reports or thresholds, but having a clear paper trail that explains what happened. Once you understand that, the focus shifts away from, "Will this trigger a report?" and toward, "Could I easily explain this if I needed to?" In most cases, 5 simple types of documents can make that explanation very straightforward. A record of why the money exists. For a sale, a bill of sale. For a gift, a brief gift letter. for a transfer, a note or record showing the original account, a statement from the account the money came from. This shows the funds already existed before the transfer or deposit, proof of the transaction itself, a wire confirmation, cashier's check stub, or deposit receipt with the date and amount. Alignment with your tax records when relevant. If you sold property or equipment, having that reported correctly on your tax return so the numbers match. A clear, concise response if a question arises. Often, a short explanation supported by those documents is all that's needed. If things ever seem more complex, that's usually the time to pause and speak with a CPA, tax professional, or attorney before saying more. Viewed together, none of these steps are complicated or technical. They're simply about keeping records that connect financial movements to real-life events. Before we wrap up, let's clear up a few myths about the $10,000 rule that cause more confusion than almost anything else. Myth 1. Depositing $9,900 keeps you safe. In reality, $9,900 is one of the most commonly watched deposit amounts, precisely because so many people believe this myth. Banks don't just look for deposits over $10,000. They also look for patterns of deposits consistently just under that line. Repeating $9,900 over and over can stand out more than a single $11,000 deposit. Myth 2. Only people doing something illegal ever get asked questions. That would be comforting, but it isn't accurate. The systems banks use are largely automated. They flag activity based on patterns, not on someone's character. So completely honest people sometimes receive routine questions about transactions that look unusual from a data perspective. Once they answer and provide documents, the matter typically ends there. Myth 3. Once I'm retired and on a fixed income, these rules don't really apply to me. The reporting rules don't include an age or retirement exemption. A 72-year-old depositing cash is treated the same way as a 35-year-old business owner depositing cash. The system records the transaction. It doesn't look at your age. Understanding that is actually helpful because once you know the rules apply to everyone, you can plan accordingly and avoid accidental mistakes. If you strip away the rumors and secondhand advice, the core reality is simple. The reporting system was built to track large movements of physical cash so serious financial crimes would be easier to spot. It was not designed to target retirees who sold a vehicle, accepted help from their children, or moved long-held savings into a new account. The automatic report, by itself, is rarely the problem. If you deposit more than $10,000 in cash, the bank files the report and, in most cases, nothing else happens. Complications usually appear when people try to outsmart the system by breaking up a legitimate amount of cash into smaller pieces, specifically to avoid that report. That pattern is exactly what modern monitoring tools are designed to detect. If there's one main idea to remember, it's this. Don't split up a legitimate deposit just to stay under the reporting number. Instead, handle genuine transactions openly and keep a few simple records that explain what happened. In practical terms, that often comes down to 3 habits. Deposit or transfer the full legitimate amount instead of chopping it up to dodge the $10,000 line. Save basic documents, bills of sale, gift letters, statements, and receipts as a short written history of where the money came from and where it went. When moving your own savings between banks, try to use one clear transfer when possible and keep the confirmation from the bank. When people run into trouble around this rule, it's almost never because they set out to do something dishonest. It's usually because they followed advice that sounded smart but turned out to be backwards, like always stay under $10,000 or break it into smaller deposits so no one notices. Transparency plus documentation is what keeps things simple. Now that you understand how this rule actually works, you're already ahead of most people. Instead of relying purely on word of mouth, you know what the banking system is designed to look for and how normal, everyday transactions fit into that picture. If you're comfortable sharing, I'd like to hear from you. Tell me in the comments which state you're in and what kind of situation you deal with most often. Selling property, receiving family gifts, or moving savings between accounts. Everyone's circumstances are a little different, and your experiences help show which topics deserve more attention in future videos. Thanks for spending this time with me, and I'll see you in the next one.